Perfect. Thank you so much. Thanks, Rick and Alminas, for putting this together. Thanks, Wendland, for already starting the conversation. I already saw there's a bunch of very good questions there, so I'm excited to present this. So this is, again, it's joint work with Steve and Stefan, who are listening and actively replying to some of these questions, and it's called the Bank Entry Channel of Monetary Policy Transmission. Okay, so let me start with something you probably don't know. There's an ex-Fed official who's suing its former employee. This is James McAndrews. Is trying to open a bank, and the business model is basically taking deposits and depositing these deposits at the Fed, but the Fed is not allowing him to do so. So this guy is essentially suing the Fed for limiting competition in the deposit market. Okay. Now, this, of course, it's an isolated case, but this is reflective of a broader pattern that has been happening in the U.S. for over the past decade. So, since the financial crisis, there's been a 97% reduction in commercial bank entry in the United States. Between 2000 and 2009, around 1,300 commercial banks were chartered, whereas in the following decade, only 40 of commercial banks were chartered. Now, many people, especially in the industry, argue that this reduction in entry is due to increased regulatory burden for banks. Essentially, it's too expensive now to start a bank because regulation is too high, it's too expensive, and therefore part of this drop is due to increased regulatory burden. Now, the starting observation that we have for this paper is that, okay, bank deposits are substitutes for government securities, which essentially provides a way for the Federal Reserve to affect monetary policy transmission, right? So if bank entry is low, then maybe there might be a scope for monetary policy to be less effective if bank entry is low. Okay, so we studied precisely this question in this paper. How do changes in bank entry, how do bank entry barriers affect monetary policy transmission? So what do we do? From a theory perspective, we build a model to study the interaction between entry barriers and monetary policy. And we propose this new channel of monetary policy transmission, which is called the entry channel. So the main idea here is that if the Fed funds and deposits are substitutes, then the expansionary monetary policy, so a decrease in the aggregate interest rates, increases bank profits. This in turn should attract new entrants and stimulate credit provision. Okay. Now, of course, if you have entry barriers, this effect might be dampened in the sense that if entry barriers are very high, even if the Fed decreases interest rate, banks cannot expand into new markets, or cannot even charter in response to these low rates. Now, we take the predictions of this model quite seriously. When we test them in the data, we test them using a new network-based shocks to entry barriers. I'm going to be very specific about what I mean by network here, but essentially you have to think about this as a network of states that arises from the bilateral interest rate branching laws of the 1980s, okay? And this network, essentially, states are nodes, and the edges of this network are determined by the possibility of banks to enter other states. And we use this network to study interaction between entry barrier shocks and the Fed funds rate, okay? What do we find? We find three sets of results. So the first result that we have is that bank entry is negatively correlated with the Fed funds rate. So if the Fed decreases the Fed funds rate, so engages in expansionary monetary policy, then there's an incentive for banks to enter the market, either by acquiring new banks, by opening new branches. I saw a comment about this is very well taken in the sense that, you know, we mean entry by literally geographic entry in the new market, and the effect is amplified by exogenous shocks to entry barriers. Okay, banks cannot respond as much if there is a barrier to entry. The second set of results is at the bank level. We showed that the deposits and lending are negatively correlated with the Fed funds rate, and that this effect is dampened when there are shocks to entry barriers. And finally, these are most exciting, I think, set of results. We find that real outcomes are also negatively correlated with the Fed funds rate. This is well established, but the effect is amplified by shocks to entry barriers. So essentially, if entry barriers are low, monetary policy pass-through is more effective. Okay, and all of these sets, there's three sets of results here, all of this, we argue that they're consistent with our channel. So let me talk about the theoretical framework that we have in mind when we talk about the entry channel. So it's a very simple deposit competition model. Essentially, banks here compete in a coordinate way for deposits in the local deposit market. So banks are going to lend at a rate S and take deposits at a rate R. And these guys both depend on the aggregate interest rate that is set by the monetary authority, which I call F. F again is set by is determined by the Fed. And each bank, there's a N bank. N is going to be an endogenous object. It's going to be determined in equilibrium. Chooses deposits D to maximize this object here, its profits. So this is NIM. This is just interest rate on loans minus interest rate on deposits times the size of the bank. Okay. This condition here, the first order conditions to this equation here, plus the entry condition here. So essentially, we allow banks to enter the market at a cost kappa, and with free entry, this expected profits have to be equal to 0. The first order condition of this and the free entry condition here determine the equilibrium number of banks and individual banks' deposits. Okay. The key assumption that we make in the paper, so we're slightly departing from, I think Steve mentioned this in Slack already, but essentially we made some changes to the theory part of the paper over the past 2 weeks. Unfortunately, and I apologize to my facilitator, we didn't have time to incorporate these theory changes in the paper, but we made some changes there. So the key assumption that we need in the paper, as it turns out, is that deposits and the Fed funds rate and the Fed funds are imperfect substitutes. What I mean by this is essentially this cross partial derivative of the interest rate to the deposits and the Fed funds rate is greater than 0. What does this mean? It means that when F is high, it's relatively more expensive for a bank to raise 1 unit of deposit, so you have to pay depositors a little bit more. Now we provide a micro foundation for this assumption in the paper, where I'm not going to talk about how we microfund this, but essentially we show that this imperfect substitutability arises when consumers have utility from liquidity services that deposits provide, but Fed funds rate don't provide, essentially. And we also show that this assumption is verified in the data. Now we have this other sufficient condition here. I also saw a question on Slack about this, which is very well taken. Essentially, we need to assume there's a sufficient condition that the partial derivative of the deposit rate with respect to the Fed funds rate is weakly larger than the partial derivative of the lending rate with respect to the Fed funds rate. There's mixed evidence on this. We find in our data this is true. It's like this inequality holds strictly. There's a concurrent paper by Drexler that shows that over a longer period of time, these two objects are essentially indistinguishable from each other. So, but again, this is sufficient condition. It's not essential for our results. Okay, this is the entry channel. What does it mean? Suppose that this cross partial derivative here is greater than 0. Then expansionary monetary policy. So if I decrease F, incentivizes entry. So again, what's the main idea here? If I decrease the Fed funds rate, then I'm increasing expected banks' profits. This is going to incentivize entry by new banks, and this is going to be incentivize entry by new banks, okay, essentially. And we have these two additional results that expansionary monetary policy increases banks' borrowing. It's cheaper now for the bank to borrow. So this partial derivative is also, so this derivative is also negative. And expansionary monetary policy also increases bank lending. So if I decrease the aggregate Fed funds rate N times D, which is we think about as aggregate deposits and lending, there's no capital here, is going to increase. Okay. Now, to test this channel, we look at exogenous shocks in entry barriers, right? So to do this, we want to study what's the impact of a change in entry barriers to these three derivatives here, 1, 2, and 3. How do changes in kappa essentially affect the transmission of monetary policy through the entry channel. And to do this, we parameterize the model as follows. So we assume that the interest rate on loans is equal to a constant times the Fed funds rate plus a constant credit spread. And the interest rate on deposits is equal to another constant times the Fed funds rate plus total deposits here. This is the total number of deposits in the economy times this function here, Z, which captures essentially in closed form what I suggest is what I mentioned as a substitutability effect. Okay, so essentially, if this guy is large, if big D, like total deposits in the economy are larger, if for a given level of total deposits, it's more expensive to raise deposits if F is large. Okay, so this the first derivative of Z with respect to F is greater than 0. Now, given this assumption, we find these two expressions for D and N, and you know, D is just equal to the cost of entry divided by Z, and N is equal to this animal here. Now, the only thing I want to take you out of these two equations is that when the Fed funds goes up, D and N goes down. So essentially, this is consistent with our assumptions here. But we want to study the sensitivity of changes in D and changes in N to the Fed fund relative to the Fed funds rate when we change kappa. Okay. Now, this is the second proposition of the paper. Essentially states how do studies how barriers to entry affect monetary policy transmission. So if you lower entry barriers, so if you lower kappa, then the sensitivity of aggregate outcome of entry to monetary policy is going to increase. Essentially, bank entry is going to be more responsive to monetary policy if you decrease bank entry barriers. You're going to have an opposing prediction for individual banks' deposits and lending. So at the individual level, if you decrease entry barriers, individual outcomes are going to be less responsive to monetary policy. But in the aggregate, the first effect is going to dominate. So essentially, you're going to have an increased sensitivity of aggregate lending to monetary policy. And I just want to show you how does this substitutability effect here, essentially this interaction term, is important for our results. Suppose that there's no interaction between total deposits and the Fed funds rate, okay, in the interest rate equation. Suppose that this first derivative is equal to 0. Then D is independent of F. D is equal to kappa divided by a constant. Why? Well, essentially the idea here is that if there's no interaction, sure, a decrease in the Fed funds rate is going to increase individual banks' level expected profits. But at the same time, it's going to attract new entrants. And these two effects at the individual bank level are going to perfectly offset each other. Okay, so you really need this assumption. Okay, now we've talked about how the model works. Let me talk about how we test how changes in bank entry barriers affect the transmission of monetary policy through entry. Okay, so the data is quite standard. We have core reports for bank level outcomes. We have business dynamic survey for MSA level results and county business patterns for county level results. Essentially, we use these data sets to measure pass-through to the real economy. And then we have this AML 1993. This is not a data set, this is a paper. We essentially use this paper that records which states pass which interstate banking agreements at which point in time to build our network. And I'll talk about this, how we build this in the next slide, okay? So the period is from the first quarter of 1994 to the last quarter of 2000, and the identifying variation comes from 1984 to 1995. So what do we do with this AML paper? So we essentially build a network of states in the United States in the 90s, in the 80s and 90s. So in our framework, we think about US states as a bunch of nodes in a network, And the links between the states are determined by the possibility of banks to enter other states, okay? So we construct what we call this reciprocity matrix, where whose mth element is equal to 1 if a bank from state M can be acquired by banks in state N, and 0 otherwise. Now, this is not completely new. We partially built on Zhang, Levin, Lin, and others, but we make some progress along a number of dimensions that I'm going to talk about briefly. So we have mainly 2 measures here that we define as shocks to entry barriers. And we argue that essentially these 2 measures are have different empirical properties, so we use them both. Okay? The first one we call states in. This is very intuitive. It's essentially the number of states whose banks can acquire banks instead M in year T. So essentially, this is a measure of how exposed my state M at a given point in time T is to potential entry by other states in the US. Okay, so an increase in this variable here essentially captures a negative shock to entry barriers. Okay, and then we have this other measure here, which we call net states in, and it's the difference between states in, so this guy here, and states out. So states out is the opposite of this. It's essentially the number of states that my banks can access at any given point in time. Why do we like this? Well, it has a nice empirical property that is 0 on average in the aggregate. Why is this the case? Well, you know, I'll be clear in a second, but essentially, for one state that I can access, this state can access my state. Now, in this other contemporaneous paper that we have with Steve and Stefan, we discuss other properties. If you want to take a look at them, and essentially anticipation, state level trends, why these 2 measures are not endogenous in a way, and then, but I'm gonna skip. I'm gonna skip all these details now in the interest of time. So just to give you an example to fix ideas, how do we think about this network and how do we build these measures? So I take the example of Colorado here as my focal state. I'm gonna look at how changes in barriers to entry are affected by this interstate deregulation between Nebraska, Massachusetts, and Colorado. Okay, so in 1991, none of the states has signed an interstate agreement. So all of these network nodes, if you want, are isolated, okay? So Colorado states in and states out are 0, and the difference, which is net states in, is also equal to 0. In 1998, Colorado signs a regional reciprocal agreement with Nebraska. So essentially it says Nebraska banks can come into Colorado if and only if Colorado banks can access Nebraska. Now, Nebraska does not reciprocate this agreement, which means that nothing happens. And we make one step ahead, we think, relative to most of the previous literature, in the sense that most of the previous literature codes 1998 as the year in which Colorado deregulated. But essentially, if you look at this picture here, nothing really changed between in the competitive environment of Colorado in 1988. In 1991, Nebraska reciprocates this agreement. So essentially it says, okay, fine, Colorado banks can come in, but Nebraska banks can go to Colorado. This entails a 1 state increase in states in and 1 state increase in states out, okay? Net, these effects offset each other. So net states in is still 0 for Colorado. Now, in 1991, Colorado signs a national non-reciprocal agreement by which essentially banks from all over the US can enter Colorado. I'm taking the example of Massachusetts. Now Massachusetts banks can go there, and this represents a shock to inward entry barriers for Colorado that is now matched by a shock to outward entry barriers, if you want, okay? And finally, in 1994, Regal-Neal is passed, and what happens with Regal-Neal, every bank can open a branch all over the US, okay? So for Colorado, from the perspective of Colorado, this states in is not changed, states out goes up by 1, and states in goes down by 1. Okay, so I said why, I mentioned why I like these measures that we have in our paper. One reason is because of timing. we think that this, our measures capture substantial variation in bank entry around deregulation. So here, what I have on the horizontal axis, I have time to deregulation, and I compare two deregulation events. So one deregulation event is this dark gray bar, which is the Krosner-Strachan deregulation event that I mentioned before. So essentially, this is the first time a state passes an interstate deregulation law. And then you have this light gray bar here that is represented states in changes. Okay, and here I'm plotting on the I'm plotting these functions of. So I'm plotting number of acquisitions and average bank assets acquired as function of time to deregulation events. And as you can see, there is around changes in net states in there are around 80 local banks acquisitions, and on average, around 3% of local banking assets are acquired in any given year. Okay, so this is the first reason why we use states. These new measures is because of timing. The other reason why we like these measures is because of time series properties. So one thing I was worried about is that the Fed funds rate has some trend, especially in the 80s, is decreasing. The late 80s is increasing and then decreasing. But then, so I'm worried that this might interact with this aggregate increase in liberalization of states, right? But net states in is zero on average. The idea again is that one state in for one state is a state out for another state. So these two effects offset each other, okay? And finally, what do we need for identification of our coefficient here, of our model here? Now, in principle, we just need that the state level deregulation does not anticipate monetary policy. Now, we're kind of confident about this. Why? Well, today, as of today, bank regulators acknowledge that the interaction, which is sort of surprising to me, even today, regulators acknowledge that we essentially know very little about the interaction of between bank regulation and monetary policy. Yellen in 2017 was calling for research on this. The BIS in 2015 set up a team composed of Fed official and ECB officials to study the interaction between monetary policy and bank regulation. But essentially, this is, if you want, it's even now the dynamics of this are unclear. What we do in this paper actually is one step further, in the sense that we need to, you really have to make a story that the network structure of this interstate banking changes, states in and states out changes, has to anticipate monetary policy, the effect of monetary policy in the economy for our model not to be identified. Okay, so essentially, we need to prove that changes in states in and net states in are correlated with monetary policy. And this is a figure that I made yesterday. I'm pretty happy about. So essentially, on the horizontal axis, you have changes in states in and net states in, and on the vertical axis, you have changes in the target Fed funds rate. So essentially, what this means is that we cannot reject the hypothesis that deregulation does not anticipate monetary policy. There doesn't seem to be any correlation between state level deregulation and monetary policy in this period. Okay, how much time do I have? 6 minutes. Now let me talk about results. I'm going to talk about two sets of results. The first set of results is about bank level outcomes, so entry and deposits and lending, and the second set of outcomes is going to be real economy outcomes, so pass-through essentially. So this is the first entry test. In the cross-section of states, we estimate this equation here. On the left-hand side, I have entry. On the right-hand side, I have this measure of changes in entry barriers and the interaction of these changes in entry barriers with the Fed funds rate. Okay, so S is going to index states, T quarters to pick up aggregate variation, including variation in the Fed funds rate. We measure entry with local bank acquisitions by out-of-state banks and by establishment of new branches. Okay, and here, what we're interested in testing is the sign of this coefficient V2. Essentially, what is the marginal effect of a change in the Fed funds rate when entry barriers are low versus when bank entry barriers are high. And the theoretical prediction is that this beta 2 is smaller, is smaller than 0, okay? So this is what we find in the data, essentially. The Fed funds rate is negatively, there's a baseline negative correlation between Fed funds and bank acquisitions, okay? So if the Fed funds goes down, so expansionary monetary policy, bank acquisitions go up, new branch establishments go up. This effect is magnified when there's low entry barriers, okay? So this interaction term is negative. Especially, this expansionary monetary policy increases the baseline correlation negative correlation between the Fed funds rate and bank acquisition, okay? And the magnitudes are pretty large. I'm not going to talk about magnitudes here, but they're quite substantial, okay? Now, so this is for bank entry. Now for bank level outcomes, we have the opposite prediction, okay? So we estimate very similar equation, but this is the bank level. We have I for bank fixed effects. And the left-hand side is going to be bank level deposits and bank level lending. Now, there's proposition 2 that I showed you before, says that at the bank level, lower entry barriers essentially dampening this correlation, the negative correlation between the Fed funds rate and the bank level outcome, okay? And this is what we find. So there's a negative correlation, baseline correlation between the Fed funds rate and lending, and there's a negative correlation between the Fed funds rate and deposits. This negative correlation goes down, is dampened when entry barriers are lower, okay? So this is exactly lining up with what we our theoretical predictions. I'm not going to talk about, by the way, I'm not going to talk about robustness here because in the interest of time, I have 3 minutes, but you can look it up in the paper. And finally, this is the most exciting set of results. It's about pass-through. How does this entry channel affect the real economy? So we start with MSA level tests. In the cross-section of MSAs, we estimate this equation here. I'm not going to repeat this because I've showed you this like twice before. But essentially, we have MSA level outcomes and annual variables. So on the left-hand side, I'm going to have firm level growth, establishment entry, and employment growth and job creation. And the theoretical prediction here is that beta 2 is smaller than 0. So essentially, low entry barriers decrease the sensitivity, increase the sensitivity of real outcomes to the Fed funds rate. And this is again what we find. So just focus on the firm growth here. There's a negative correlation between firm growth and the Fed funds rate. If the Fed funds rate goes down, then firm growth goes up. This negative correlation increases when bank entry barriers are low. And then you can see this is also true for establishment entry rate and establishment exit rate. We look at employment. We have very similar results here as well. Here is zero correlation between employment growth and the Fed funds. But there is a low entry barrier essentially lead to a negative correlation between these two guys, okay? And all of these directions are consistent with what we have in our theoretical predictions. Now, we run additional tests. We find that this is a result I was really happy about in the sense that what I presented you was at the MSA level using a business dynamics survey. We took a completely different data source, which is county business patterns, different level of variation. Essentially, the results, even in magnitudes, are essentially almost identical. And there seemed to be some interesting interaction between how credit constrained firms are. So we showed that these real effects are stronger when establishments are small, so they have less than 100 employees, suggesting that this might be very dependent on bank lending, and in counties with ex-ante more levered banks. The one result I want to leave you with is there is asymmetry in this effect, okay? it seems like this entry channel stems from expansionary monetary policy. So when the Fed funds goes down. Here I'm splitting the Fed funds rate changes into positive and negative changes. And you can see that essentially both economically and statistically, the correlation between the negative correlation comes from negative changes in the Fed funds rate as opposed to positive changes. So essentially what this suggests is that might suggest that the decision of banks to enter a new market, either by chartering or by opening a new branch, is somewhat of a irreversible investment, by which I mean, you open a branch, but it's very hard to sell it exposed. But it also has some important policy implications because now suggests that the entry channel might be stronger in low interest rate environments, like such as the one we're facing right now. But if entry barriers are high, then this entry channel might not as work. So the Fed is, decreasing interest rate, doing quantitative easing on one side, but it's increasing bank entry barriers on the other side. These two effects might be leading to counterproductive. So basically, they might offset each other. Okay. Okay. Let me conclude, since I think, yeah, I'm 1 minute late. So in this paper, we asked how entry barriers in banking affect monetary policy transmission. And to answer this question, we built a model where monetary policy transmission interacts with bank entry barriers. So we use this model to derive some testable predictions. And we argue that our results rely on the substitutability between the deposits and the Fed funds. So we test this model using network-based shocks to local entry barriers, which arise from the deregulation of the 1980s and 90s. And we showed that low entry barriers actually increase monetary policy pass-through. And we refer to this channel as the entry channel. Again, we are, we think that our findings are demonstrating complementarity between monetary policy and bank regulation, in the sense that monetary policy might be less effective in passing through to the real economy when banks face high entry barriers to enter new markets, which might have important policy implications for post-crisis re-regulation. Thank you. I'm looking forward to the chat.